What I tell my clients all the time is I don't think there's any really universally good or bad investments. It's just based on how and why you're using them, and they can make sense given the criteria that we establish to use for our clients. So sometimes it makes sense to pay more in fees for an investment that my client's going to sleep better at night with.
Welcome to the Active Advisor Podcast, brought to you by Harbor Capital. Join us as we learn from pros who have helped thousands of investors live better lives. I'm Bryan Moore, and I'll be chatting with some of the brightest minds in the financial advisory business, bringing you insights on practice management and investment research that works for advisors and their clients. Joining me today on this episode of the Active Advisor Podcast is Bruce Berry. Bruce, a seasoned financial consultant and wealth advisor, is the founder and driving force behind Genesis Financial Partners, a firm that's dedicated to providing highly customized investment services and strategic wealth planning. With decades of experience navigating the complexities of finance, Bruce brings a wealth of knowledge and expertise to the table. Join us as we explore his journey and uncover his unique approach to building custom solutions. Welcome, Bruce, and thanks for joining us.
Thanks for having me, Bryan.
So here on the Active Advisor, we always like to get the conversation started by asking each of our guests, what's the first memory you have related to money or investing?
Sure. I thought about this a little bit. And I guess looking back, I started my first paper route in the third grade. My older brother had the route for a long time and decided to play high school football. So I was sort of forced to take over the reins. I'll never forget, it was about 2.5 miles out in the country, east coast of Canada, where I grew up. About 2.5 miles for about 18 deliveries. But yeah, you learn quickly the value of a dollar. My mother would take my tips and the regular money that I made. And back then, late 70s, early 80s, we were earning upwards of 17, 18% in Canada savings bonds. So it worked out pretty well as an investment as well.
That sounds like it actually, I think people would go crazy for those rates if you get them today.
Hopefully inflation doesn't allow us to get back there.
Well, true. That's an excellent point. What it takes to get there is a whole different story. Having had a paper route myself, I think you learn a little bit more when you do those paper routes out in the country, as I did. It sounds like you have to kind of learn to get a little bit of grit and fortitude as well, because those early morning hours along those old dirt roads can get a little interesting in a young man's mind.
Yeah, for me, it was after school. I'll never forget because people complained. I did it for a few years. And when the weekly rate went from 75 cents to $1, there were a handful of people that were a little upset with me, but that just, again, shows the power of inflation. 75 cents a week to $1 back in the late 70s, early 80s was a lot more money than it is today.
Very true. So building on that first memory, can you tell us more about your background and what ultimately led you to founding Genesis Financial Partners?
Yeah, so that's a lot, right? You can talk about academically. I went to school in Ontario, Canada. My first undergrad was in international relations, which is a combination of political science, economics, and history. Graduated in 1994. And then the school I was at offers a 2-year Bachelor of Commerce for people that have undergrads already that want to get a business degree. So I did that. I got my Bachelor in Commerce with a major in finance. And when I was completing that degree, one of my finance professors was actively involved in what was called the Canadian Shareholders Association, which simplistically was just his attempt at creating more investment groups. So very fundamentally oriented, teaching people the basics of investing. What is a PE ratio? Where is the company currently as it relates to historical PE ratios? Are they towards the high end, the medium, or the low, which is something we still sort of talk about today. So he got me involved in that. I was learning to educate people about investing. And then at that point in time is when I also took a larger interest myself in how the stock market worked, both the theoretical side of it as well as the practical side, which don't always match up as you might think.
Yeah, I think PE ratios are something that we talk about now, but definitely have not been kind of a investment criteria for the past decade.
Yeah, I mean, at the end of the day, something's worth what somebody else is willing to pay for it. And sometimes the winners continue to win regardless of how expensive they might be from a PE ratio. And the market doesn't always make sense in the short run. But then if you listen to someone like a Warren Buffett, ultimately in the long run, a smart, objectively based model is going to win out, which is why he's very comfortable betting most of your venture capital types in his model versus theirs.
Yep. No, very true.
And that can be a tough lesson to learn, having that kind of short duration versus long duration kind of bet on. Looking back, speaking of tough lessons to learn, obviously we're going to fast forward a little bit, but was there anything that you kind of look back on now and go, wow, that was, I found in my own firm doing well, but man, there's this one or two things that I wish that were just a lot tougher than I anticipated when I went independent.
You know what? I've always had a mindset, an entrepreneurial mindset, again, from the beginning, whether it be delivering papers, which you can kind of consider a commission business, to selling shoes at Foot Locker, to selling Cutco knives in high school, college. Most of my jobs have always been commission oriented, which is ultimately the biggest risk, is being a commission type person. So I've always been comfortable with that. The only thing I would look back and say to myself is, I wish I would have gone independent quicker. And I wish I would have put together this firm quicker than I did. But in reality, it was still only 5 years into the business when we went sort of independent solo on our own as a group. So that's still pretty young compared to most.
Yeah, no, that is. So it sounds like you were 5 years in, obviously, as you just mentioned, and you decided to go independent. At that point in time, around your 5 year mark, was there anything that kind of led you to want to go, that desire to go more independent? Or is there any advice you would give somebody if you're having these thoughts and questions? Maybe you should look to make that splash.
Yeah, so I think it was a combination of things. Being unhappy with the group I was working for at the time was part of it. You know, some people are leaders and some people are followers. I'm more of a leader, but a leader of one. I don't generally like to manage people either. I'm fiercely independent. So that was one sort of motivating factor. And then the other is, I always try to look at my profession from the client side of things and say, if I were a client, what would be the characteristics I would look for? And of course, you want to like and trust the person that you're working with, but you want to work with someone who's independent, that doesn't have a line of products that they're forced to sell through their employer. And I've really, in my career, have really never, short of my very first year in the business, I've never been in the position where I was forced to sell a proprietary product. I'm proud to say that. I like to say that. So when clients ask, what does the model look like? I'm very comfortable explaining to them why I've made that choice. And the only recommendation to people starting out is, I would say, get independent as quickly as you possibly can. Once you're locked into, whether it be a big wirehouse or a big proprietary firm, and they kind of have you, they make it hard to leave. That's a smart business decision on their behalf. Whether it be the legal side of things, or just, it's hard to leave a practice once you've established it. So like I said, try to get independent as quickly as possible is certainly a valuable lesson that I learned.
And when you made that decision, obviously it was a little while back there, you probably had a couple of choices out there at the time. I think more so probably exist nowadays. We've interviewed we've had a couple of advisors from LPL on, and it seems to me like that is, I wouldn't say the go-to place, but it definitely is one of probably the top selections on that. Would love to hear what, in your opinion, I guess, drove you and the rest of the firm to LPL at that point in time. And what do you see now as some of the bigger draws?
Sure. So we absolutely did our due diligence. We were not in a rush to leave our former broker dealer. We were with them for over 20 years and overall had a great relationship. Sometimes you don't know what else is out there. And we felt like we had a good deal. And I think we did. In the big picture, still a better package than most people that say work in a wirehouse type environment. What we felt was writing on the wall. They struggled, as a lot of firms did, to recover from COVID from an employee standpoint, a service standpoint. So we started to see an erosion or sort of a deterioration in the quality and their capability to service us to the extent that we had hoped for. They'd always been a little behind in technology. So when we did our due diligence there was really only about 2 or 3 firms that we looked at that we knew were at the top level of the independent broker dealer channel. LPL is the 1,200 pound gorilla in the room. The one thing I would say is it wouldn't be a firm that I would recommend for a brand new person. They're not big on, they expect you to know the business and know it well, which I respect. But as a function of that, if you do know what you're doing and you do have good support staff, the payout, the package, the technology, the offerings, it just makes it, to me, the ideal independent candidate. We'd never considered becoming our own RIA. That's just a different level of risk and compliance we don't feel we need for the size of the firm that we are. So to be able to outsource that through them and just focus on what we're good at just made it a perfect fit. 2 years next month, we will have been with LPL.
Very nice, and congrats.
Thank you.
I definitely, it's funny. You definitely hear a lot of people make that shift. And when they do make that shift, it opens up a lot of different avenues for them. Like you mentioned previously, you're not kind of beholden to putting certain products into your clients' portfolios. And your, I guess, spectrum of investable instruments increases quite drastically, which for you, I think is a good thing, which we're going to talk about. I'd love to shift gears and talk about. In our previous conversation, you referenced the movie Jerry Maguire and the viewpoint that fewer clients equates to better relationships. Love to hear more your thoughts on that and what it means to you.
Yeah, I've always thought of it that way. I know a lot of people, when they start off in the independent channels, are taught to think of themselves as either an asset gatherer or an asset manager. And in my case, it's both. That's the decision I've made, is to have both roles. And in part because of that decision, there's really a limitation on how many clients, or in my case, I look at each unit as a family. There's only so many families that can properly, once you extend yourself too far, and again, that's a different business model. You have to have other advisors, you have to have other service staff. And again, I'm fiercely independent, but I'm also fiercely protective of my clients. And the thought of outsourcing any of my clients, whether it be from a financial planning perspective or a money management perspective, to somebody else, isn't something that I'm willing to give up. So yeah, I mean, his role, and again, the point of the movie was fewer clients are better. And the big firms and the wirehouses, they don't want to hear that. They want to hear, how much are you going to grow by this year? How many new assets are you going to bring in? And that's fine for them. But for me, I've got to a point where I'm very comfortable, and I'd rather just take fantastic care of my existing families. And as a function of that, I still get a few referrals here and there that have allowed my practice to grow at a very competitive rate. I think with the LPL metrics that they show me, I'm top 10 percentile in virtually every metric that they measure in terms of asset growth, assets under management, et cetera. So it still works just fine. But I'm not doing it by adding 10s, 20s, 30s, 40s, 50 clients a year. It's 2 or 3 or 4 select really good clients that fit my model well. And that's how I've been growing.
I have to admit, after we had our initial conversation, you mentioned Jerry Maguire. I had to go back and watch the movie because the only part that stood out in my mind was "Show me the money" when Junior was or when they were talking. But you're right, he did, and I think it sounds like on both sides, it's leading and it's led to a more harmonious outcome, kind of a better quality of service for your clients. Having less, I guess, more kind of time to focus on your existing client base. How has that enabled you to kind of customize your approach for each one of those clients and differentiate yourself from other advisors?
Sure. So I think a few things. When you have more time available to dot the I's, cross the T's, you really do a deep dive, right? So back in the day, the client has an old 401k. I need to roll that into an IRA, get those assets under management and start charging. And not to say that's not part of the process, but review with them the deep details. Is this all IRA, or 401k? Is it 401k? Are there Roth contributions? Let's review, as we're moving that money over, how you originally set up your beneficiaries and why. Do we need to make updates? Maybe you didn't have children and you do now. Maybe you've updated your trust and we need to add your trust as your contingent beneficiary with your spouse's primary. Hey, you're getting ready to retire in the next few years. Why don't we link that account to your bank account so that when you retire, we can just automatically send funds from the account to your bank? A lot of deep dive details that often get missed because, again, when you're younger and you're hustling and you're just focusing on the next dollar coming in, some of those other details get forgotten about. And a lot of times they end up being more important than the performance of the account, whether it be somebody who got divorced and forgot that they left their spouse as a beneficiary, as an example, or somebody might have passed on and they didn't decide if that's going to be a per stirpes beneficiary status or something different. So working with my assistant to make sure all those details are covered goes a long way. And a lot of times the benefits derived from those can be as or more important than the actual performance of the account.
Do you also go so granular as to really look at each family unit and kind of have a different holdings in each one of those accounts? I mean, you kind of really going down to the portfolio construction level and differentiating?
Yeah, one of the things that we have the ability to do at LPL that I appreciate is sort of household, where in isolation, let's say a client might have a Roth IRA for it with me that they don't plan on touching, maybe even as an estate planning tool. And we'll discuss, well, if we're not going to touch this account and it's designed for your beneficiaries, to me, it makes sense for us to be pretty aggressive there and maybe more aggressive than we otherwise would be in an account that we're going to be living off of when we retire. So having those conversations with the client, making sure that they understand that one individual account might not look diversified, but so long as the big picture is properly diversified and we're matching the individual accounts with the needs of what those accounts are going to need to provide in the future, they see the logic in it. I've always said there's a clothing store in not far away that says something along the lines of an educated consumer is our best customer. And I fully endorse that. The more my clients know and understand why we're doing things, the stickier they are as clients, the more they buy in. I'm not just the guy that manages their old 401k, which is now an IRA. It's get a more detail oriented relationship where they feel like they can ask me any money questions at all, as simple as I'm thinking about leasing a car versus buying, or I've got something I want to do to the house. Should we look at a line of credit, or should I dip into my after tax savings, or every little detail they're comfortable calling me just to get that second opinion to make sure that they feel like we're all on board with the same kind of decision making.
That's awesome. And I think that definitely kind of sounds like a higher level of service that your clients are receiving and I'm sure deserve. Is there something specific that sticks out in your mind that you can offer today? And maybe it is kind of a wider range of choices, investable choices that you weren't able to with prior firms?
Yeah. So one of the battles that is going on right now, and if you look at the last 30 years that I've been doing this, when I started, there was such thing as B shares in mutual funds, and they've since gone the way of the dodo. Now C shares are facing a similar plight. Again, I moved to fee-based back in roughly 2001 is when I started that transition. Within the fee-based platform, firms have to look at profitability and decide how they're going to make money. And within the fee-based realm, separately managed accounts are a huge component of that. And as such, a lot of firms dealing with those companies either have revenue sharing, which is fine as long as it's disclosed, and or they have platform fees that the advisor via the client pay for that allows you to pick between various money managers offered. And that seems to be the big push. But I think from a cost standpoint, the advisor driven model that does not have the platform fees that allows me to directly choose the individual investments, which in my case are going to be a combination of stocks, low cost ETFs, index funds, has really allowed me to bring my fees down quite substantially compared to the sort of SMA model, which is guessing the most popular model currently with RIAs or independent advisors.
And so your clients definitely benefit not only from lower fees, but also your added ability to influence those investments.
Absolutely. And a great example, it's almost April 15th. The ability for me to manage their after tax money in a tax efficient way. Yes, there are solutions for that, but I think having a customized view of that, having those conversations fourth quarter of every year with my clients that say, hey, listen, even though we had a great year, we're up maybe 20% in a year like 2023, we are actually going to have some tax loss harvesting. You're going to take home a realized loss. And they find that initially kind of hard to believe. But maybe, yes, it was a great year, but maybe they had some bond funds that underperformed or some international. Certainly the growth in the market last year was primarily large cap growth and specific to about 10 companies that drove the entire market. So when you explain to them is, yeah, you had a phenomenal year and we own some of those great companies like an Amazon or NVIDIA, but we also had some losers. We actually were able to sell those in the fourth quarter, get you some tax losses that we'll use up a little bit this year, and anything we don't, we can carry forward. You don't get that type of service and explanation from an SMA. They'll tell you they're going to do it, and some of them do it well, but to be able to visually show them exactly what you're doing on a customized basis, I think just reminds them that this is a little different than just owning a mutual fund or that sort of thing.
Oh, that's awesome. I definitely appreciate you taking time out to speak with us about that. Is there a story or an example that sticks out in your mind that you're definitely taking a much more personalized approach in each one of your clients' lives and families? Do you have one story that kind of where you walked away and you felt like you had a really positive impact on their lives?
Yeah, so I was thinking about that, and there's actually two, and they're very, very similar. It's beyond the scope of, hey, I picked a good stock or a
Of
mutual fund. Those
course.
are not exciting stories. Let me tell you two real quick. They're very similar. One of which was a attorney. Probably he had another 10 to 15 years before retirement working for a large firm and was unhappy, constantly told me how unhappy he was working for that firm. And I suggested the idea of going solo practice. And he was a high stress, wired kind of individual. And it took us about a year for me to convince him it was the right way to go. And the next 10 years of his life, he couldn't stop talking about how happy he was that he had made that decision. And it worked out fantastic. And the numbers made sense. He was more profitable. He was happier. And then, very similar to that, but somebody that changed professions entirely, a client that I've worked with for the last decade, was a teacher until about 3 years ago. His side hustle, if you will, which he loved to do, landscaping, big outdoor projects. And he was doing that really just in the summer months. And we ran through the numbers of, hey, I'm giving up a pension, I'm giving up benefits. Like, let's go through all the numbers and make sure that I got a wife and two kids at home. I don't want to make a bad financial decision. And we walked through all of it, took our time to sort of map out. And within a year, he was making more than he was as a teacher. And the additional income is going to more than offset what he gave up in the way of benefits, pension, et cetera. But more importantly than any of that, he's happier than he's ever been. Teaching, and I grew up, my mother was a teacher for over 40 years. And I know the highs and lows of that. But it's to see somebody be this much happier than they were is way more valuable than, hey, Bruce got me a rate of return X last year, which, yeah, in the small picture, that's fun, but it doesn't mean anything in the long term. So those are the kind of rewarding things that I cherish the most.
Definitely, Ben. That's awesome. Final question for you. At Harbor, we're firm believers in active management, though it's important to acknowledge that every financial expert has their own unique perspective. From your experience, where have you observed active management making the most significant difference?
Yeah, that's a great question. Over the last 30 years, you always hear the debate growth versus value, and there's going to be winners and losers in that back and forth. And similarly, active and passive, I think, is a little bit more complicated discussion because I could certainly make the argument that you can be an active manager using passive investment instruments, or you can be an active manager using actively managed funds. And is it fair to say that the vast majority of mutual funds don't beat their index? It is, but I also find that complicated because a lot of mutual funds aren't designed to beat the S&P 500, as an example. But for those who are, is it fair for a client to ask, Bruce, I own this large cap blend mutual fund. Shouldn't we be competing against the S&P? And that's fair. And what I will tell them is, yeah, my objective is to try to create alpha, right? Which is just to say, on a risk adjusted basis, are we beating the index? And is that easy to do consistently? No, which is why I do not sell myself on performance. I'm going to put myself and my clients in the best possible position to compete with and beat the index. And we're going to have good years and years where we don't. But I think active management definitely fits in. Where I think it fits in best are active managers that are maybe individual sector utilizers, or perhaps beating or knowing more than Fortune 500 companies than all of the analysts that are out there is pretty difficult to do. But there's a lot of sectors, whether it be healthcare or international or small cap, where you could certainly make an argument that an active manager that knows what they're doing can get rid of some of the companies that simply don't belong from a growth perspective. So yeah, I think everything makes sense in the right context. That's what I tell my clients all the time is I don't think there's any really universally good or bad investments. It's just based on how and why you're using them. And they can make sense given the criteria that we establish to use for our clients. So sometimes it makes sense to pay more in fees for an investment that my client's going to sleep better at night with. And similarly, I don't mind paying a management fee for a manager that can show me that they have a propensity to beat their relative index and or create alpha and have a track record that shows that. So yeah, I use a mix of both at the end of the day.
Excellent. And there was a great point that you highlighted that active management doesn't just mean necessarily all actively out there picking stocks. It could be you're actively picking other managers. So this is the final round. I love to call it the lightning round, but officially it's 60 seconds with Bruce Barry. Let me know when you're ready, sir.
Shoot.
Nickname.
Barry.
Hobby.
I love to play golf whenever I can.
Profession if you weren't in finance.
It would still be sales in some way, shape, or form. I love the interaction with clients. So if I was selling paper door to door and I get to interact with clients every day, I could probably find myself really happy doing that, as long as I'm selling something that I believe in and selling it to people that I like.
Hidden talent.
I'm a much better than average cook.
What's the best professional advice you've ever received?
My dad, when I was young, told me, because we went through some tough times living on a farm and through ups and downs. He said, if you have the choice working for a company, be on the income side of the income statement as opposed to the expense side, because when times are tough, we cut on the expense side before we cut our salespeople.
Biggest risk you've ever taken?
Leaving a big box firm, going independent with a group of, not one of us that was even 30 yet. Most of us only had a few years experience in the business, and we left it all.
Bucket list travel destination.
I'm thinking 2026, we're going to do Italy and Greece.
Last TV show you binge watched?
The Gentleman.
What never fails to make you laugh?
I still love dad jokes.
So what's something you wish you were better at?
My wife would tell you a dancer.
What's a most likely place to find you on a Saturday afternoon?
If the weather's good, hopefully at the golf course.
What's one question you think all clients should ask their financial advisor?
I think making sure that they're an RIA. I probably rank number one. What I tell most people again is, let's hope you like and trust your advisor as a starting point. But after that, their level of independence is important. It's not crucial. It's not like you can't have a great long-term relationship with someone who works with proprietary products, but in a perfect world, you want someone as independent as possible.
Most rewarding part of your job?
Nothing gets me happier than getting invited to a college graduation party for one of their kids that we mapped out 5, 10, 15, 20, 25 years ago.